The Japanese yen has hit a historic milestone, plunging to a staggering 40-year low near 162.5 against the US dollar. By the end of this video, you'll grasp why this 162.5 level is now seen as the ultimate danger zone for global markets and how a massive unwind of carry trades is already rattling Japanese equities. So, what's behind this dramatic shift? Despite previous efforts to stabilize the currency, the yawning yield gap between Japan and the US keeps favoring the dollar. We're witnessing a historic divergence, with the carry trade reigning supreme. The yen's current slide isn't just a passing phase, it's a monumental 40-year low, leaving the Bank of Japan in a precarious position for its next policy move. The numbers are eye-opening. US dollar to Japanese yen is approaching the critical 162.5 mark, a level that has triggered intervention watch around the globe. Adding to this intensity, Japan's June Producer Price Index, or PPI, surged by 7.1%, marking its fastest growth since 2023. This producer price shock indicates that the weak yen is driving up imported inflation, compelling the Bank of Japan to consider a more hawkish approach, even as the economy struggles. On social media platform X, the atmosphere is charged. Traders are dubbing the 162 to 163 range the intervention zone. Analysts are pointing out that past attempts to stabilize the yen have failed, as the pair bounces back to hit new 40-year highs. There's a rising sentiment of a failed narrative regarding the BOJ's strategy, with many noting that carry trades are thriving despite warnings from Tokyo officials. Professional analysts are raising alarms about extreme short positioning in the yen, currently at a 4-year peak. This creates a significant asymmetric squeeze risk. Should the Ministry of Finance decide to intervene with actual dollars, the resulting liquidation of yen short positions could unleash wild volatility across global currency, equity, and bond markets all at once. The repercussions for Japanese stocks have been severe. The Nikkei 225 recently plummeted by 2.6%, erasing around 27 trillion yen in market value. This is a classic example of a carry trade unwind, where positions are liquidated to manage rising interest costs. Over the past 21 days, cumulative losses have soared to an astonishing 82 trillion yen as the June BOJ rate hike begins to impact leveraged positions. The yen's decline is also closely linked to soaring oil prices, which sustain the carry trade while further straining Japan's trade balance. This creates a vicious cycle. Higher energy costs lead to more yen selling, which in turn drives up imported inflation. A sudden move by Tokyo to strengthen the yen could trigger a liquidation of yen-funded carry trades in US equities and even the crypto markets. For individual investors, it's crucial to keep an eye on official statements and the pivotal 162.5 price level. Risk management is essential, as positioning is at an extreme. Be cautious with highly leveraged long dollar positions right now. An official move could trigger a rapid appreciation of the yen. Monitoring PPI data and BOJ policy changes will be vital for timing your next steps in this currency cycle. Looking ahead, our AI models project 3 potential scenarios. In the base case, the yen fluctuates between 161 and 163 as the MOF employs verbal interventions to slow its decline. In a bearish scenario, without intervention, we could see US dollar to Japanese yen hitting 165, exacerbating imported inflation. On the flip side, a bullish scenario might involve a surprise 25 basis point hike by the BOJ along with direct intervention, potentially sparking a dramatic rally back toward the 155 level. To wrap things up, 162.5 is now the battleground. PPI inflation is surging at 7.1%, and the Nikkei has already seen a wipeout of 27 trillion yen. The pressure on the BOJ to act is mounting. If you found this deep dive insightful, please subscribe to Tokyo Macro and give us a thumbs up. What do you think? Will the MOF intervene this week? Share your thoughts in the comments.